Remember when the FDIC bankers held a meeting months ago talking about the collapse of banks, but didn't want the public to know and described it as a professional need to know?
Should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do, that we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Here's a fun fact for you. 150 climate change tech companies were banking with Silicon Valley Bank. Here's a brief summary of what actually happened and why. Silicon Valley Bank, or SVB, which you probably never heard of before this week, collapsed in less than 48 hours. This is the 16th largest bank in the United States and the largest collapse since the global financial crisis of 2008. And there could be a domino effect that affects every single one of us. SVB primarily lends to high-growth startup and tech companies. In 2020 and 2021, these high-growth startup tech companies killed it in the market. So SVB was doing very, very well. At the end of 2019, SVB's total deposits were about $60 billion. By 2021, they had tripled their money to around $180 billion. So what did SVB do with all that money? They dumped a bunch of it into mortgage bonds. But starting in 2022, the Fed increased the interest rates, so money became more expensive to borrow. As a result, SVB's investment value began to tank. Recently, they took a $1.8 billion loss, and SVB's CEO, CFO, and CMO sold millions of dollars worth of shares of their company. The investors who had their companies working with SVB started calling the owners of those companies to get their money out of that bank now. People began catching on through social media, fear took hold, and within 48 hours, the bank completely shut down. The really bad part is that over 95% of the people banking with SVB have deposits that are not insured. This could spread like wildfire to other banks and affect us all in a very bad way. On the heels of the Silicon Valley Bank collapse, Coinbase and Binance, two of the largest crypto exchanges, just made concerning announcements. Keep in mind, this is the same Coinbase whose website assures customers, quote, for customers with a US dollar bank account, 1 USDC can always be redeemed for 1 US dollar, giving it a stable price. Always, that is, except for this weekend. Coinbase tweeted, we are temporarily pausing USDC-USD conversions over the weekend while banks are closed. During periods of heightened activity, conversions rely on USD transfers from the banks that clear during normal banking hours. When banks open on Monday, we plan to recommence conversions. Here's the thing, banks are closed every weekend. They also assure customers, quote, your assets remain safe and available for on-chain sends. Is this kind of like Kramer assuring Bear Stearns customers to leave their money in the bank right before Bear Stearns jumped off a cliff?
Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly. The ninth best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yes, some of them come back here with the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls 66% like SVB Financial did last year, it takes it a lot more to recover. After losing 2/3 of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce back moves might be far from over. These stocks could have more room to run, especially if you think they were driven down to artificially low levels by tax loss selling, artificial dumping.
This is the same Jim Cramer who just had the audacity to tweet on March 10th, 2023, JP Morgan is a fortress. Please learn from history. Don't doom yourself into repeating it by following the advice of experts like Jim Cramer. If you have your crypto on an exchange, you don't own that crypto. The exchange does. If they're not your keys, they're not your coins. It would be wise, and you'll never regret the move, to take those coins off of the exchanges and put them in your own private wallet. Write down your keys and seed phrases and lock them in the safe. The question is, how much USDC does Coinbase and Binance have parked in Silicon Valley Bank? What's their actual exposure? Will they be left holding the bag? And if they do have major holdings in that location, that bank's not going to open on Monday or any other Monday after that. Circle is a peer-to-peer payments technology company that manages the popular stablecoin USDC. USDC is a cryptocurrency, the value of which is pegged to the US dollar. They tweeted, following the confirmation at the end of today that wires initiated on Thursday to remove balances were not yet processed, $3.3 billion of the $40 billion of USDC reserves remain at SVB. Like other customers and depositors who relied on SVB for banking services, Circle joins calls for continuity of this important bank in the U.S. economy and will follow guidance provided by state and federal regulators. If that's not a call for a bailout from the U.S. government, I don't know what is. And what if they don't get that bailout? What happens to that $3.3 billion of USDC? The system that allowed banks to buy low-yield, long-term held-to-maturity so-called assets is responsible for all of this. The system has been rotten to the core for a long time. And in case you didn't know, all this long-term yield buying and speculation helped fuel inflation as well as cause the current catastrophe you're seeing unfold today. The question is, isn't there a better way than 100-year-old technology? People in the crypto space say, yes, there absolutely is. And also, in case you didn't know, here's how you know the banks are scamming you. When the banks have $1 in their vaults and $10 of possible withdrawals, you've got a musical chair scenario, and it's just a matter of time before the music stops and you've got no chair to sit in. It's financial Russian roulette. You're actually playing a dangerous game with the product of your time and labor by parking that cash in the bank and watching it deteriorate in value. Just don't think about where your money actually went. Right, U.S. government, Ukraine, military industrial complex, prison industrial complex, foreign aid. There's actually a solution to fractional reserve. It's for banks to hold the actual cash, charge you actual fees to do so, and charge you by the minute for support. But they won't do that because that would be an honest business practice, and banks really aren't into honesty. They could make money on fees instead of musical chairs, magic wand yield hunting with dodgy yield products from the government. So why are banks collapsing? Because the Fed destroyed the value of the safe long-term U.S. treasuries they bought. And the government is in the banking business because it allows them to deal with and create a dishonest cash flow that they can shove onto unborn generations. The elites at the top get to extract all the value, while the peasants at the bottom are left scrambling for all the leftovers, hoping their money won't continue to devalue as it continues to devalue. Sitting on tons of cash is almost always a bad idea. But you know what they say, it's always darkest before you completely black out. The question is, how bad do you actually think it's going to get before all's said and done? Leaving your thoughts in the comments below is one of the best ways to help engagement on this channel. Subscribe, like, and share this video. If you want to support the channel, grab a hard-hitting conversation starting design you can get from the store. You can put it on any shirt, hoodie, mug, cell phone case, whatever you want. Thanks for supporting me with your view and your like, and I'll see you in the next one.